Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracey Reineck, and this week I'm joined by Sheraz Mian, Zacks Director of Research, who also is secretly, or was one, an oil analyst.
That's
for
right.
7 years. So we always bring him on when we have questions about oil, and he joined us about 5 months ago in December 2015. You can check out that podcast at all the usual locations like SoundCloud, because it's definitely worth listening to that one. I listened to it before I came in here to see you today, Sheraz, and a lot of your predictions about what was going to happen with the oil market appear to have becoming true.
Oh, I got lucky.
You're like
Very
the
good.
oil whisperer or something. So everybody should definitely tune in for this entire episode today, because I think there's going to be similarly a lot of good information about what's going on in the oil markets and with the oil stocks, because we covered them last time. So we're going to kind of revisit what's happening with them now, because a lot has changed. I know I said in December that I'd have you on it about 6 months, but it's about 5. But I felt like after this Doha meeting, and we're getting earnings in the next week or two from some of the bigger oil companies, that this is a good time to have you return.
Sure.
So what I guess I should start with I'm going to start with the rig count, because we did that the last time too.
Sure.
And I thought it was very interesting to see kind of where we were and then where we stand now. So let me see. I have all the stuff here. I know I was... okay, so last time when we were discussing the rigs, we had a U.S. rig count of 744, and that was as of the end of November 2015. The U.S. rig count had been all-time high of 2,031 in 2008. And even as of November 2014, it was still at 1917. So we thought, last November, 744 was pretty low. But as of April 15th of this year, 2016, the U.S. rig count is down to 440 now. So that's a pretty dramatic drop. Just a year ago in April 2015, it was at 954. So it's dropped almost 50% or more from a year ago. And then I had some other interesting stats I thought was kind of interesting about the rig count. Most people don't pay attention to this, but Canada is now down to 40 rigs. They were at 80 a year ago. And then the international rig count is at 985. That is down from 1,251. So that's also a pretty significant decline, because I know after this Doha meeting, there are all these headlines like, oh, they still aren't freezing, they still aren't cutting, they meaning like the Saudis,
That's
the
right.
Iranians, and all of the big players. But when you look at these rig counts, it seems to me like it doesn't matter. Who cares what they're doing, because
Absolutely.
everybody else is not producing anymore.
Yeah, what the major consequence of the so-called shale revolution was that the U.S. oil industry became the world's swing producer. What was disappointing about 2015 from long oil perspective was that the expected decline in shale production turned out to be a lot slower than many of us were predicting. And I mentioned it on that podcast too, that I had Chevron in the top 10 portfolio, and it was the worst performer in that portfolio that year. I always expected, on reasonable grounds, obviously, that with prices so low and many of these operators barely getting their earning back their margins, production has to decline. And we're starting to see that, particularly in the more expensive areas like the Bakken and the other shale areas. So yes, the rig count is down and production is coming down. So we had 9.5 million barrels a day U.S. volumes last year. The EIA, the U.S. government's Energy Information Administration, is expecting that to drop about 8-9% this year and further 7-8% in 2017. So we are seeing that low prices are the best solution for what needs to happen to the commodity.
Yeah, and that's what you said last time. You said that there would be an equilibrium on the supply and demand once the
Absolutely.
prices got low enough to take production
That's
out of
right.
the picture.
Yeah.
And we saw that develop.
I never bought into that the sky was falling kind of a narrative when prices fell into the 20s and everybody was saying this is the new normal now and we're going to have prices in the 20s and maybe the low 30s at the tops for years and years to come. And I just didn't really see that scenario unfolding unless you have some really big development on the economic front globally, like China really blowing up, for example. Short of that, I expected prices to eventually stabilize and stabilize in the high 30s and the 40s and then keep creeping up. And that's what we have seen. And I think that's still the more reasonable base case outlook for the commodity.
So this rally from around 30 up to over 40 now, some people are calling it, oh, it's just speculation. And it's just everyone thinking there were going to be freezes at Doha and that will, go back down to 30 now that there's not going to be freezes. Based on what you just said, you would disagree with that.
I disagree with that. I had I appreciate all the press coverage of the Doha and all the hopes that that some people were pinning on that meeting, but the serious people that I follow didn't really see any possibility of Russia and Saudi Arabia agreeing to a production freeze in the absence of Iran. It's just not in their strategic interest. So the serious people did not expect any type of production cut to come out of Doha. What's happening is on the ground in the U.S., and that's showing up in the numbers that you pointed out. We don't get production numbers in real time as we do with the rig count, but as is the rig count coming down, so is production, and U.S. production, is slowly and steadily coming down.
Yeah, I saw some of the North Dakota statistics because we briefly discussed them in December too. They're the number 2 oil producer in the U.S. now after Texas. And they had 64 rigs in December, and that was low, considered to be low. And now they're at 29.
That's right. Yeah. No, it's a lot of the operators who were kind of borderline on their financial health are just not getting the margin and exiting the market. And the North Dakota volumes should be coming down pretty strongly this year and into next year. So that's the trend that'll unfold.
Okay, so in December, this was your big prediction. And this is why you're the oil whisperer now. You said by the middle of next year, so the middle of 2016, we would have sharply lower U.S. inventories and that you would see a reasonable high in oil towards the end of the year in the 50s to mid 60s.
I think that is playing out. Yeah, the inventories are still on the elevated side, but every market is forward-looking, and market participants could see that the U.S. production, particularly from the shale basins, is coming down, and that's starting to show up in the pricing data, and demand is holding up. China is not blowing up. The U.S. economy is steady. It's not growing very fast, but it's not heading into a recession either. And all of that, the sum total of it, is showing up in prices. It's not speculation. I mean, speculation is just a dirty word for regular trading activity, but folks are putting their money into a favorable, more constructive outlook for the commodity, and one could reasonably draw a scenario where prices should stay into these high 30s and mid 40s range and stabilize around that level, and then start heading actually higher towards the end of the year and into next year as we see more production come offline from these expensive U.S. shale regions, and the doomsday scenarios about the Middle East doesn't come true.
So far, if we're switching over to how to invest into this, we talked about a lot of companies in December. Nobody had blown up yet. There
That's
were a
right.
few bankruptcies of the small guys. There was a lot of doom and gloom. There's a lot of discussion about dividends being cut. But here we are 5 months later. And outside of Anadarko, that they did cut their dividend
That's right.
81%. Nobody else that I saw had cut it.
That's
at
right.
least not of the majors. None of Exxon and Chevron and BP all still pay their dividend, which you also predicted. You said it would
That's
hell
right.
would freeze over or something
That's right.
by the time if they ever cut it.
That's right.
So they're all still good to go. And so what is the outlook for investors who want to get into this area?
I think it's all comes down to your risk profile. You want to have a dividend, or you just want to have a pure play E&P type of player, which is so more leverage to the movement in oil prices. If you want a dividend, if you want a relative security, I still like Chevron.
Okay.
I think people have raised all kinds of questions about its dividend, but I think that will absolutely be the last thing that the board will approve before they cut everything else. So of the majors, I think Chevron gives you the more bang for the buck, not only in regular income, but also leverage to oil prices. Among the pure play E&Ps, I mentioned Pioneer Natural in December. We had put that in the top 10 portfolio for this year, for which I got a lot of emails from subscribers saying that didn't you learn any lessons from from Chevron last year? And it's the best performing stock in the top 10 this year.
Yeah, I looked it up. In the last 2 months, the shares are up 35%.
Yeah, so it's been a good pick. The Overall, I would say that if you are interested in E&Ps, you have to be mindful that prices could go down again, and we could have that credit risk type of situation reemerge as what we saw in January, February. So you want solid balance sheets. You don't want exposure to the shale plays, as attractive as they will be in the long run. For the next couple of years, you want good traditional legacy producing regions like the Permian Basin. And if you want more security within that parameter, then look for folks that have a lot of their production this year and next hedged. And that's why I went with Pioneer. They are oily.
You said that. What does that mean?
What it means is that the standard typical E&P is about 2/3 natural gas. And as bad as the outlook for oil has been in the recent past, the outlook for natural gas is outright ugly. So you want E&Ps that have more of their volumes in liquids, so oil or natural gas liquids. And Pioneer is one such company. It has more than half of its production is oil. The majority of its production is hedged, and pretty much all of its production is coming from the Permian Basin. So it checks all of the boxes that I like to see in an E&P. There are one or two more relatively on the smaller side, one or two more on the relatively bigger side, on the E&P side too. If you want, I could mention those.
Yeah. I'm definitely. What about the small guys? I know people are really interested in those.
That's right. So in the 5 to 6 billion market cap, there's this company called Diamondback Energy, and the ticker is FANG, FANG. It's also a Permian-based operator. Excellent balance sheet, very good assets. The downside is that they don't really have anything hedged for this year or next, so it gives you a lot more leverage if prices are going up. But the inverse is true as well. On the large cap side, I prefer Occidental.
Okay.
Occidental has really cleaned up its asset base. They sold pretty much all of their less attractive assets, particularly in California. Excellent balance sheet, a lot of Permian producing assets they have. They pay as good a dividend as Chevron
Yeah, I
does.
looked at that.
That's
It's over
right.
4% right now.
And this is about as secure as Chevron's is. So a very good pick, more secure, less risky, pretty good dividend, and should give you good leverage to rising oil prices as well.
What do you think of the opportunities for consolidation for, people to buy out other people? We talked a little bit about this 5 months ago. Obviously, assets got pretty cheap there in January, February, and nobody
Sure.
was really biting. There was no announcements of anything, but I think part of that is because it was pretty dark and gloomy.
It was very the sentiment was really down on the sector, and then we know the credit markets kind of became tough for these guys too, and everybody was concerned about just being able to run their own operations. So I think consolidation will continue. It's happening a lot on the services side. We have the Halliburton Baker Hughes thing is going on, and I think there'll be plenty of that on the E&P side as well. But it'll have to be these big operators, the Chevron and the Exxons and the BPs of the world, and they. At present, at least, feel they have plenty of their own assets that they could operate better in the current environment. But I won't rule out that these guys will swoop in and pick up some of these good names, particularly even some of the ones that we mentioned here.
Is it too early to get into the service side? We didn't really discuss the service side at all 5 months ago, but you just brought up like Halliburton and the Baker Hugheses, and there's a lot of smaller guys. There's a lot of companies that fly out to the rigs and take
That's right.
equipment out there. They're all hurting. But should I just stay away from those and focus on just the oil story?
That'll be my suggestion. Yeah, I think if somebody wants to have a more diversified exposure in the oil patch, I would suggest something like Schlumberger, which gives you the global presence, and they bring in the expertise to the operator to help them more economically and more efficiently squeeze the oil out of the ground. But on the whole, my preferred picks would be amongst the E&Ps and the majors, not the service guys.
Okay. Also for investors, I know that they're looking at the PEs on a lot of these companies. Some don't have PEs because they're not going to make any
That's
money
right.
this year and maybe not even next year. Who knows? But the big cap guys have crazy high PEs because the estimates, the earnings are expected to be so low for this year, 2016.
That's right.
It is expected to rebound pretty dramatically for 2017, especially if your theory of, the rising oil prices
That's right.
comes true by the end of the year. But should I just ignore the PE?
Yes, the regular PEs don't really mean much for energy companies, and the primary reason for that is that these are deep cyclical plays. So at the top of the cycle, when everything is great, their PEs are at their lowest levels, and at the bottom of the cycle, their PEs are at the highest levels. So they don't really have that meaning that you would have in a Walmart's PE or in any other regular company's PE. So you have a view for the commodity, and then you look for the companies that, in your judgment and based on your risk profile, gives you the best bang for the buck. And depending your risk profile, you could go in E&Ps among the names that we mentioned, or if you want to go in the majors, I always come back to Chevron, and I think that really does it. Yeah.
Now, what about the recent run-up we have seen in a lot of these stocks? The majors haven't run as much as the E&Ps, but that was to be expected. We even kind of mentioned that 5 months ago when we said, if you want more of the safety and the dividend, you go into the majors. The E&P is always more volatile.
That's right.
But we've seen pretty big moves up.
That's right.
Is it still early in the cycle, though? Is there still room left in a lot of these
Absolutely.
companies?
I think if you are if you are approaching this from a trading perspective, then you probably want to wait for pullbacks. But for long-term investors who want energy exposure and see this as a core key part of the economy and should be a core key part of their portfolios too. It's pretty early for them, and picking the chevrons and the PXDs and the accidentals at these levels, these are still excellent values.
Okay. Do you have any predictions that we can have for now that we're 5 months later? Are you sticking by your same thing for the end of the year?
That's right. I think prices stabilize or around current levels or higher over the coming months. We exit 2016 at a level higher relative to what we entered in 2016, and 2017 is a steady move higher for the commodity, and that should pull the entire sector upwards with it.
Okay. Well, this has been good. Another good discussion. We'll probably do it again in another 5 or 6 months and kind of see where we stand. If you want to listen, like I said, to the old podcast, you can definitely find it on SoundCloud.com. I think it's like number, I want to say 13 or 14, a podcast number. But wait, it's 8. 20, this one's 28. I know, but the first one we did on oil, I think it's like 12 or 13. No one here knows. But it was in December. You can definitely find it if you scroll down the list. And it's definitely worth listening to that one to get a good perspective on kind of how far we have come and now where we stand. But we definitely still like the same companies that we liked last December. So definitely check out all the tickers and all the stocks mentioned in both of these podcasts. And of course, you can always check out Sheraz's articles that appear weekly on Saks.com and mine as well. And we also now have the podcast on a couple new locations. If you get the Amazon Echo, you can now listen to us as you walk around your house or wherever you have your Echo set up, because the podcast is available on the Echo now too. So check us out there, and of course on iTunes. And that's it. And so for next week, I'll have another good guest, and we'll see where we go with our stock picks next week. So until then.